the appointment. I'm Shireen Bhan, and we're in conversation with Deutsche Bank's Gurrit Chadha. Gurrit, always a pleasure having you on the channel. Thanks very much for joining us. Let me start by asking you about the investor mood. Deutsche Bank says tactically cautious, strategically bullish. Is that an indication that the Modi rally, the Modi wave that we talked about the last time that you were on the channel, and everyone's been talking about post the elections that the NDA came to power, has started to peter out, has started to wane, has lost its wind?
So thanks, Shireen. Always a pleasure to be here. So let's start with the strategically bullish part of it. So go back 9 to 12 months, and the big issue, which was sort of the big spoken word, was policy paralysis. And then you look at all the reforms which have happened over the new government coming into place, right? You have the FDI in insurance, done. FDI in defense, done. Coal bill,
FDI
done.
Pension, notified.
There you go, right? The coal bills, done. The mining bills, done. You've got defense deals, the difficult defense deals, announced. You've got direct cash subsidies for cooking gas, done. Diesel deregulation, done. Two other very important reforms underway, right? Obviously, there's a lot of political debate around those. Very important, both the GST as well as the land acquisition bill. So if you put the totality of the reforms which have happened, right, and add to that the foreign policy on which some very interesting moves have happened, I have to say, most people, including myself and global investors, would say a huge amount has happened in terms of policy paralysis. That word ceases to exist right now, and it's been a huge amount, a wave of structural reforms. In fact, I would argue many have argued that Mr. Modi and the government have been in a hurry to do this, but equally the impatience of the society.
Well, that argument holds because of the ordinance route that the government decided to take on a lot of these crucial reforms that you're talking about. There's no argument that the policy paralysis is over. The concern is that all of this is not yet translating into a recovery on the ground, despite what the government holds out in terms of the GDP growth figures, which the government itself, by the way, took with a pinch of salt before they finally decided to adopt the CSO's numbers. But whether it's 8 or 8.1 or 8.5, whatever the case may be, it hasn't started to reflect yet in corporate earnings. We've seen the earnings calendar so far on corporate earnings not looking very good, in fact looking disappointing, and that's where the concerns seem to stem. Do you believe that in the short term we are likely to see more volatility, more pain from a stock market point of view specifically?
Okay, so now we're addressing a very different investor constituency, moving away from the FDI, moving away from long-term strategic capital, on which, as we said, a lot has been discussed, a lot has been done. Let's move now to the financial investors who are coming into the stock markets. So I think we've got to put a few comments on the table. One is that globally, growth is much more challenged today than, frankly, where we thought even a year ago, right? U.S. mixed data out there. We thought U.S. will grow at about 3.5%. U.S. is looking like growing more at 2.8% this year. China slowing down faster than most thought, right? Europe and Germany have actually done pretty well as a combination of the oil coming off and the euro playing into the export strength. But overall, macros globally are challenging from a growth standpoint. Then you put the relativity of what did India do to the rest, right? India actually took not the monetary path to kick-starting growth, right? In fact, if anything else, people would argue India has been very cautious on the monetary side. You've had 100 billion of reserves getting created over the last 18 months. You've stabilized the FX. You've got current accounts deficits which have contracted significantly. But in the bargain, India did a lot of the structural reforms even around itself rather than use the monetary lever. Now, then you were sitting on valuations in India which were looking pretty expensive, right, relative to any other MSCI, relative to China, the others. 2015 comes along. You have China suddenly unleashing monetary policy again, right, off a base of much lower valuations and liberalizing and attracting foreign capital. And you saw what happened to the Shanghai index, and you saw what happened to Hong Kong, right? I mean, they're off a flyer this year. Ruble starts to come back, right? And you see ruble gaining strength off a very low base. Right? Europe comes back courtesy both oil and partly the depreciation, and money starts to move into Europe. So tactically, India, which was, you could argue, overweight most investors and looking expensive at 17, 18 times earnings, and the fact that monetary policy lever had yet not fully kicked in, I don't think it's a surprise. But we should really judge the government.
So a quarter, 2 quarters down the line, what are you estimating?
So it's a function, one, of global growth, right? We need global growth to stay fully intact. We think global growth, 2015 growth at about 3.3, 3.4%, no different from 2014. A little disappointing in that. We would have liked higher than that. There is excess capacity sitting globally, right? So there are some challenges in global growth. My view also is that a lot of Indian corporates were sitting highly levered, right, with high cost of capital, right? Hopefully, as those start getting corrected, right, they pull down the leverage with raising the money as they're doing, and cost of capital comes down, and we can talk about monetary policy. I think you will find that there is a resurgence happening as far as companies' top lines and margins are concerned. I still think we need to be patient into the second half of the year.
So you're sticking to your Sensex year-end target of about 33,000?
Well, I have no really comment on that. That's our analyst, and I'm sure he's been right in the past, and there's no reason why he couldn't be right this time.
Okay, let's talk about some of the triggers that you spoke of. Let's start with the FOMC. And as you rightly pointed out, and this is the view of most people that we speak with, as well as the government and the Reserve Bank governor, that India is much more secure today and less vulnerable to the possibility of the Fed hiking rates. When you envisage that, and what could the short-term impact really be as and when the Fed does decide to hike?
So I wish I had a crystal ball. Unfortunately, we don't. But given the mixed data coming from the U.S., right, though we still believe that notwithstanding a weak first quarter and some of the weakness carrying on into the second quarter as well, we think U.S. still will have a stronger second half. And you could see U.S. coming back into the 2.83% growth rates. In that scenario, we think the Fed hike comes in September, and probably into December if the weakness carries on, right? So that's the timeline we're thinking, September onwards for our rate hike. From a vulnerability standpoint, actually it's very interesting. The most vulnerable still are the Latin countries. Asia is somewhere in the middle. But within Asia, actually it's only Thailand and India who have changed their position on the current accounts. Thailand's actually gone surplus, and India's contracted the deficit significantly. India stands out as actually having made the maximum move towards being less vulnerable over the last 18 months, right, since the first taper came into play. And while I would have to say that there will be an impact on the currency, there will be an impact on the capital flows, India stays relatively better hedged today than, frankly, most of the other countries in Asia.
Okay. Will the impact be significant in the short term, in the immediate term post the hike, I mean?
Yes, it could be significant, certainly, and which has always been our advice to corporates that do hedge your dollar liabilities out. We still are buyers of great dollar strength, so there could be an impact on corporates' balance sheets, and you just don't want to get into that. But I have to say, the bigger impact on Asia is going to come not from the U.S., it's going to come if China really slows down. If China gets into a hard landing, right, and starts to reflect growth, which is sub 6%, which I think they will again quickly use monetary policy and get into a form of China QE coming into play. But if China slows down faster than most people would anticipate, right, then I think Asia really is vulnerable.
But what are investors telling you about China? And you preempted my question, because that is the big worry in the room at this point in time. And this may be a strategic decision on the part of the Chinese government to actually slow things down deliberately, consciously. But what's the sense that you're getting from investors about what could happen if we do see a sub 7% growth rate for China?
So we believe you actually will see a sub 7% growth rate for China, right? So it may be 7 this year, kick-started by monetary policy which gets much more favorable. But there is slowdown happening in China on the property end. There is slowing down happening in China in industrial production, on retail sales. But what the government is doing, very interestingly, very much like the Indian government, is actually making the structural reforms. So they are truly trying to liberalize capital markets. They're trying to move from SOE-led into the private sector. They're actually leading to better efficiency of their state-owned enterprises. They're truly trying to internationalize RMB. You could see China in the SDR basket in 2015, end of 2016. So China is doing all these structural reforms they have to. And then we think they will use the monetary policy lever, both on reserves as well as on the rate. And hopefully that even if they get into the 6 or near 6%, it kicks back into the close to 7%. But often it doesn't play out the way you intended to. We think China has the leadership and what it takes to navigate the economy. It has the resources. But if China were to actually slow down into that 6% or below, I think we have a serious vulnerability for Asia, which is very dependent on China, right? Because remember, global trade is not going to be an offset to China now because global trade is slowing down. U.S. is slowing down. Europe, while it's surprising on the upside, and especially Germany, but Europe is going to grow at about 1.4, 1.5% in 2015. That can't offset a slowing China.
No, that is clearly a cause of concern. But you were talking about monetary policy in China. Let's talk about monetary policy in India. Governor Rajan has surprised the street with out-of-turn policy cuts. Given the commentary coming in from the Reserve Bank of India, where inflation currently is, and of course the macroeconomic picture, do you believe that 25 is what we can expect in this year, or do you think that 50 could perhaps be the cut that we could anticipate for this year?
Well, firstly, the governor has a very high credibility with international investors, and he has more data points than any one of us do, right? So let's give the benefit of doubt there. Also, we have to recognize that over the last 12 months, whether it was stabilization of the currency or getting inflation down by about 400 basis points, or really creating resilience as far as the markets are concerned, I think India stands out and stands apart as having done a very, very good job. But on a spot basis, you have ECB, which is really pushing down the QE. You could have ECB, you could have EU generate over 4 trillion of surpluses over the next decade. You have China, which may be kickstarting a QE. Japan is going to continue its easing policy.
Right.
And US may defer out, right, its rate hikes. Put that scenario together. And I see a lot of the Asian economies, whether it's Indonesia, whether it's Korea, whether it's Thailand, all getting into monetary loosening, right? India cost of capital stays high, right? So either we should have greater flexibility to Indian companies to raise global capital without the restrictions of end use and tenor and size and pricing. They could raise rupee bonds, for instance, right?
Sure.
Or otherwise we have to get into now starting to lower the cost of capital. Our view is that most countries are front-loading monetary policy right now. India would stand out if it did not. It already is at a point where I think it should be hurting demand. A lot of the inflation right now is more food-linked. So unless the monsoons turn out to be terribly bad,
which is a worry at this point in time, the Met is forecasting a subpar monsoon.
I think RBI will be wise to watch what happens in the monsoons, early monsoons.
So status quo in June?
No. Well, our view is that you could have policy rate cuts happening both in June and August. I would think that somewhere between a 50 to 100 basis points
50 to 100
in this financial year could well be warranted, right? Notwithstanding what it does to potentially the currency as a result of the U.S. rate hike, right? But given the fact that there is slowdown happening around the world, right, I think you need some monetary levers coming into play, sitting in the comfortable position which we are today relative to 12 to 18 months ago.
Okay, the Reserve Bank governor talked about it. The Minister of State for Finance talked about the possibility of full capital account convertibility. How do you react and respond to statements like that?
I think, in my view, and that's clearly my personal view, I have not discussed this either with the governor or the Minister of State for Finance, but it's my personal view that India is still several years away from that, right? And wisely so. Now, that's not to suggest that we should liberalize the markets to allow greater depth coming into the bond markets. We should do that. We should very definitely reduce the cost of capital for Indian corporates by allowing them greater access offshore. Let investors come and buy rupee paper traded on the Euroclear. Let's make sure that the restrictions start to come up for Indian companies to hedge their currency risks without being too prescriptive. I think all of that is a move towards capital account convertibility, and frankly, China has the same view. China has exactly the same view, internationalize RMB, and then over time move into current account convertibility. But do I believe that we are short distance away from being currency convertible as we are in many other parts of the world? I don't think so. And I don't even think that that's the way we should go. I think we should We should keep some prudential norms, right? Allow global access of capital, but ensure that Indian corporates are hedged on the exposure. That's a much better way around it, rather than completely opening markets to make it capital count.
Well, on that note, we're going to take a break, but when we return, we continue our conversation with Gunit Chadha.